Ever looked at the stock market and wondered how people figure out the right price for an option? It seems like some kind of magic, right? Well, today we're going to pull back the curtain on one of the most famous tools in finance, the Scholes model. And don't worry, I'll break it down in a way that's simple, practical, and maybe even a little fun. No advanced math degree required, I promise. So, what exactly is the Scholes model? Imagine you're buying a ticket for a concert that's happening in 3 months. The price of that ticket today depends on a few things. How popular the artist is, the face value of the ticket, how much time is left until the show, and maybe even the interest you could earn by just keeping your money in the bank. The Scholes model does something similar but for financial options. It's a formula that calculates the theoretical price of a European-style option, which is just an option you can only exercise on its expiration date. The model was a game-changer when it came out in 1973, developed by Fisher Black, Myron Scholes, and Robert Merton. In fact, Scholes and Merton later won a Nobel Prize for it. Why was it so revolutionary? Because it gave traders a logical framework for pricing options, moving it from guesswork to a more scientific approach. Now, let's get into the key ingredients of this famous recipe. The model considers 5 main factors. First, the current stock price. This one's pretty obvious. The price of the underlying asset is a huge driver. Second, the strike price of the option, which is the price at which you can buy or sell the stock. Third, the time to expiration. The more time an option has, the more chance it has to become profitable. So time is literally money here. Fourth, we have the risk-free interest rate. This is the return you could get on a super-safe investment, like a government bond. It represents the opportunity cost of tying up your money in the option instead of earning that guaranteed interest. And finally, the 5th and most interesting ingredient, volatility. This measures how much the stock's price is expected to swing up and down. Higher volatility means bigger potential price moves in either direction, which makes the option more valuable because it increases the chance of a big payoff. Think of it like this. You're trying to guess the future price of a stock. The Scholes model doesn't actually predict the future. Instead, it calculates the option's price based on the probability of the stock price ending up above or below the strike price at expiration. It uses all those 5 inputs, stock price, strike price, time, interest rate, and volatility, to come up with a fair value. So if you have a call option, the model figures out the chances of the stock price finishing above the strike price. The higher that probability and the higher the potential profit, the more the option is worth today. It's all about weighing the probabilities and potential outcomes in a systematic way. Of course, the model isn't perfect. It makes a few assumptions that don't always hold true in the real world. For instance, it assumes volatility and interest rates are constant, which we know they aren't. It also doesn't account for dividends paid by the stock unless you use a modified version. And it's designed for European options, not American options, which can be exercised anytime. Despite these limitations, the Scholes model is still a cornerstone of modern finance. Traders use it as a benchmark. If the market price of an option is way higher or lower than the Scholes price, it might signal a trading opportunity. It provides a standard, a common language for everyone in the market to talk about option values. So, the next time you hear someone talking about option pricing, you'll know the secret sauce behind it. It's not magic. It's a clever mix of current information and a bit of statistical probability, all wrapped up in the elegant Scholes formula. It helps us understand the complex world of options by breaking it down into 5 key parts. I hope this demystified the Scholes model for you. It's a powerful tool, and understanding the basics can give you a much better perspective on how financial markets work. If you found this helpful, give this video a thumbs up and hit that subscribe button for more content that makes finance easy to understand. Thanks for watching, and I'll see you in the next one.